Car insurance has officially reached crisis levels. There, I said it. And I mean it, because really, what is it even saving you anymore? Car insurance is supposed to protect you from catastrophic loss, but forgive my cynicism for feeling like it's designed to protect insurance companies more than the drivers themselves. And I know, it's always been like this, right? Insurance companies always want to insulate themselves and limit their risk. They don't want to have to pay out over something preventable, air quotes. But premiums and deductibles are increasing just to have plain old liability coverage. I'm not even talking about comprehensive or collision. And it's gotten to the point where an alarming number of motorists are now choosing to roll the dice and simply nope right out of insurance coverage entirely. And let me tell you something, partner. This crisis has the potential to affect everybody. Not simply because you're sharing the road with uninsured motorists, but because insurance companies are essentially redefining how they approach claims and how much they're willing to spend. Alright, it's the end of the year, so let's close out 2025 by diving into one of the most contentious issues in the auto industry today. The ticking time bomb of car insurance, and how it affects the insured, the uninsured, and everyone in between.
Roman report at the end of the month, and I make what I want when I feel like discussing cars.
A report by Bloomberg on December 5th noted that the number of car insurance claims has decreased by some 8.5% through July. Which sounds good until you realize that the cost per claim has been increasing, according to findings by J.D. Power and Associates back in October. And throughout all of this, the average number of miles driven continues to rise, and this leads to some troubling implications. The Bloomberg article states, quote, "The disconnect reflects an increase in the number of Americans who are foregoing car insurance altogether or downgrading from comprehensive or collision repair coverage that can add more than $1,000 to annual bills. Nearly 30% of Americans have dropped or traded down insurance policies in the past year, with cars being the most common choice for cutbacks over homes and health coverage, according to a survey by independent insurance agency Guardian Service Holdings." End quote. Essentially, I think the implication here is that drivers are avoiding making claims because they don't want their costs to increase, because the presumption is that once you make a claim, you become more expensive to insure, at least according to the insurance company. And so they increase your rates to sort of justify the risk that you represent. But another troubling potential implication here is that drivers aren't making claims because they simply don't have insurance in the first place, which is a really big problem because it's hard to justify actually paying for car insurance if you're just never going to use it, except that the law requires you to have it. J.D. Power's findings back in October noted that 26% of auto insurance customers currently have deductibles of $1,000 or more. As a result, approximately 7% of auto insurance customers have reportedly avoided filing a claim out of concern that it could lead to their rates increasing. But that 7% is just a drop in the bucket compared to the results of a survey by loan platform LendingTree, which found that 39% of insured drivers would rather pay out of pocket for repairs than file a claim. And that makes sense because if you have a really high deductible, you might as well just take care of the repairs out of pocket. But the thing here is that while it sucks to have to meet a higher deductible before insurance starts paying out, it gets worse when you consider that premiums, the price you pay each month just to have coverage in the first place, are ballooning like holiday waistlines. The Bureau of Labor Statistics found that car insurance premiums have increased a despair-nurturing 55% since February 2020. In just the last 5 years, the premiums have gone up more than half. And so people are doing what they can to stay ahead of all of this. So how are they doing this? Well, for one, some people are choosing policies that have higher deductibles but lower monthly premiums, presumably rolling the dice that they won't end up needing to file a claim. Households with newly licensed drivers, meanwhile, are making those kids wait until prices come down, or until they can afford to pay their own insurance. Take your spot on the sandwich line at Wawa, Jimmy, and get to making those burgers we have no business selling. Hope you like standing for 10 hours and then clocking out smelling like pickled sorrow. You know, I feel bad for the kids who've been waiting forever to get their license only to be told they're too expensive to insure. Although I also feel for the parents in this situation every bit as much, because you want your kid to have those life skills, to be more prepared for the world they're entering into. But then sometimes teaching life skills means saying, hey, pay for your own insurance. I don't care that you're 16. I mean, you're living here rent-free. What else do you even have to spend money on? So it's understandable either way. Of course, while you could debate the merit of some of these approaches, I don't think any of them are as extreme or potentially life-ruining as choosing to drive uninsured altogether. A woman named Zoe told her story to NPR back in October, and it seems that while, yes, she did make the choice to go uninsured, she was kind of penalized twice for that choice. You see, she had bare minimum coverage, but an accident totaled her car, and that coverage couldn't pay the difference. And between buying a new car and an unexpected rent increase, she couldn't keep up with the insurance payments, so she simply drove uninsured and very carefully until she could save up enough money to reactivate her coverage. But the catch here is that you have to pay a penalty to get your coverage reinstated once it lapses. So she's essentially caught between a rock and a hard place here. A woman named Kelly told MarketWatch a similar story in an article released just before Christmas, in which she shared that her car insurance lapsed after she lost her job in July 2024 due to Hurricane Beryl. Yet when she tried to reinstate it, her 3-year safe driving record wasn't enough to overcome her coverage lapse. And when coupled with a less than ideal credit score, her premium was quoted at $476 a month. And this was in addition to the $605 monthly loan payments on her Volvo sedan, which was already 7 years old by that point. As Kelly would explain to MarketWatch, quote, "That was when it became very clear to me that if I buy myself insurance, I'm literally not going to be able to go grocery shopping for my daughter and me to eat dinner at night. And I'm sorry, but I just can't, you know? I'm not going to not feed my child so that I can have insurance." End quote. So Kelly drove uninsured, but she eventually received a ticket earlier this year for driving without insurance. So she made a concerted effort to find the money in order to get bare minimum coverage. And she did. She does have coverage now. But if the worst happens, she doesn't know if it's going to be enough. But it was what she could afford. So Kelly told Marketplace that now, every time she drives, she says a little prayer. Quote, "Please just make sure that I am aware of my surroundings and everyone is aware of me so that I can get there safely and nothing happens to me or my passengers or my vehicle because I can't afford it. I can't afford it, Lord." End quote. It's a sad story, and while I feel like I know some sections of the automotive community well enough to know that at least some of the responses to stories like these are likely to be along the lines of, well, they shouldn't live beyond their means, or they should have got a more reliable car, or maybe they shouldn't have had kids, or maybe they should have shopped at Aldi. I ultimately feel like most people don't willingly price themselves out of security by insisting on a Scat Pack or a Sasquatch trim. Not everybody who is in dire financial straits is in that position necessarily because they lived irresponsibly. If Star Trek has taught me anything, it's that you can make all the right moves and still lose. So while those big spenders absolutely exist, I don't think it's a fair instinct to cast stones when the average citizen is a T-bone accident away from having 3 meals a day of just saltine crackers and boiled ice cube soup. Which is not to say that it's ever okay to drive uninsured, but I guess I'm just trying to empathize because I imagine it's terrifying to feel like you have no choice but to drive uninsured. If nothing else, it's worrying that the percentage of uninsured motorists is at double digits, around 15.4%. So, why is this happening? Why are car insurance costs skyrocketing? Well, for one, cars cost more now. That's the simple answer, but it's actually worse than that, if you can believe it, because the prices on parts required to fix them have also increased exponentially, particularly parts manufactured outside of the United States. And when you factor in the fact that many of today's cars have complicated tech systems that may require specialized tools and knowledge in order to repair, you can see how insurance companies would rather just declare these cars totaled and cut you a check. And that's a very simplistic way of sort of framing it, because the reality is that there are state mandated total loss thresholds that are governing these insurance companies and their actions, so that once repairs exceed those thresholds, they kind of have to declare it totaled. Let me explain, because you see, the total loss threshold varies by state. Most just go by a percentage of the car's actual cash value, meaning that if the actual cash value of your car is, say, $25,000, and the threshold percentage in your state is 60%, like it is in Oklahoma, then any repair bill exceeding $15,000, so 60% of $25,000, means your car is declared totaled. But Oklahoma is an example of a state with a very low threshold, relatively speaking. For instance, in Alabama, it's 75%. In Florida, it's 80%. In Texas, the threshold percentage is 100%, which probably makes it the safest place to own a Cybertruck. And then you have states like the wonderful Commonwealth of Pennsylvania. You see, we use a formula that adds the cost of repairs and the salvage value of your car, and compares it against the actual cash value of your car, so that if repair plus salvage is a larger number than the actual cash value, then that bad boy's totaled. And it makes sense, yet what kind of sucks about this is that totaled isn't necessarily the same thing as unsalvageable, right? A car can be damaged but still fixable. Yet damaged but fixable cars might still end up being declared total if the cost to fix them exceeds their actual value. So that means that those fixable cars that don't end up on a site like Copart to get auctioned off probably just get parted out and then sent to the scrap heap. Cars that could potentially help repopulate the used market. Because one side effect I haven't seen discussed very much, if at all, is that these cars being taken out of circulation creates an artificial sense of scarcity. For example, let's just say used car demand stays the same, or even increases. It is going to lead to some real problems if supply doesn't rise to meet it. because there's a finite supply of used cars on the road, and that supply is shrinking faster than a project car savings fund. Oh yeah, doing your own build seems like a good idea until you realize how much Bondo costs now. I guess what I'm getting at is that once the demand outpaces supply, that's when automakers and dealerships have all the leverage to charge whatever insane Mr. Krabs number pops into their head, and then it all feeds back into the system. Insurance companies don't want to pay to fix a car because cars are too expensive to fix, so salvageable cars are taken off the road. Used car supply decreases, car prices increase, and insurance companies don't want to pay to fix a car because cars are too expensive to fix. It's an Ouroboros of liability. And I can see the rationale because it really doesn't make sense to repair a car whose repairs cost more than that car's actual value. And this would be true even if the car's damages and repair bill didn't meet the total loss threshold, but just got really close, you know? But the thing I keep coming to is that while insurance companies can save money by just declaring a loss and then paying the consumer, I'd be surprised if an insurer saving money ever actually meant anything good for the consumer overall. Because I'm sure there are plenty of people who would rather pay their deductible and then have the insurance cover the rest to have the car fixed than to have it declared totaled and have to enter the used car market all over again, and with nothing more than a check from the insurance company that doesn't even reflect the value that you paid for the car, or any work you may have put into its upkeep, or any remaining balance on an auto loan. Car insurance can be a headache even when your car is working, much less when you get to the part in your car insurance journey where it's time to call the company's tab. You pay all this money as a contingency, and then that dark day comes, and yeah, getting a check is good. It makes your worst day a little bit brighter. And sure, it's hard to ever be in an accident that totals your vehicle and not come out in a worse position financially. But the system feels kind of designed to leave people in a lousy place. And if I'm perfectly honest, I don't even know what the solution is beyond cheaper premiums that better reflect the value they're going to tell you your car has when they declare it totaled. But then, I'm not sure that that would make financial sense for the insurance companies either. It's like the struggle is just hitting everybody. LendingTree released the findings of a survey back in September that found that 43% of insured motorists cited monthly premiums as causing the greatest financial hardship of having car insurance. But what interested me the most about this survey is that while many of the respondents cited car insurance as a burden, many of the motorists stated that they felt the cost was justifiable. Quote, most insured drivers, 64%, report that their car insurance is worth the cost, particularly high-income earners. 3/4 of those who make an annual household income of $100,000 or more say their coverage is worth it. Following not far behind is Gen Zers ages 18 to 28 at 72%. End quote. It doesn't really surprise me to learn that high-income earners would judge their car insurance as being more valuable, because I imagine it's less of a burden the more money that you make. But people from late teens to late 20s feeling the same way was kind of a surprise, because I would presume that they don't have the same earning power, that they're not in their best earning years yet, unless they're in some kind of field that their best earning years are when they're younger, like an athlete or a content creator or something. But ultimately, at a base level, they're kind of right in the sense that it'll always be better to have car insurance than to not have it. So in that sense, having it is worth it because it means you're not breaking the law. But then paradoxically, it does seem like more and more people are choosing to have it and then not use it. even when they're injured as a result of an accident. Alright, so it's one of the major factors that we need to address that is actually outside of the immediate auto industry, yet continues to contribute to the state of car insurance today: the high cost of medical care. If you get hurt in an accident, even a minor injury can be profoundly expensive, not just for you, but for your insurance company. In America, anyway. And this is before getting into issues of who was at fault. In most places here in the US, you have to have some kind of bodily injury liability coverage so that if an accident is your fault and people get hurt, those people won't be left holding the bag for all their medical expenses. But let's say you are injured. Well, hospitals want that money most expeditiously, and it can take a while to determine fault from a legal perspective. That's why some states actually require medical coverage within the auto insurance coverage itself, such as personal injury protection, otherwise known as PIP, or medical payments coverage, otherwise known as MedPay. This is so that somebody can pay the hospital for keeping you alive sooner rather than later. Now, from my understanding, while both PIP and MedPay cover you and your passengers in an accident, the difference between the two, other than which states use which one, is that PIP also covers related costs like lost wages, whereas MedPay doesn't. But the nature of your coverage will determine whether it's your car insurance or your health insurance that pays out first. And in accidents where you aren't at fault, the other driver's liability coverage will also kick in at some point once a settlement is reached. But the problem for car insurance companies here is that while they don't always have to pay on your behalf, when they do have to pay medical costs, they generally have to pay way more than they used to, owing to the unique challenges facing the healthcare industry today. And I'm not just talking about the costs of medical equipment, but overlooked problems like labor shortages resulting from innocuous changes like retiring professionals, and more unfortunate causes like people leaving the healthcare field altogether due to burnout and stress. It's been projected by the Health Resources and Services Administration that there will be a shortage of more than 300,000 RNs, 146,000 licensed nurse practitioners, and 124,000 physicians in the United States by the year 2027. Because of all these staff shortages, more and more hospitals are resorting to contracted professionals, some to the tune of hundreds of millions of dollars per year. That extra expense is cooked into these hospital bills, which get passed down to car insurance companies when they have to pay out an injury claim. According to a study by auto claims and collision repair platform CCC Intelligent Solutions, the average payout for a bodily injury claim between 2023 and 2025 jumped up to $27,600 per injured party, an increase of 35%. And so as a result, rates get jacked up for everybody to make up the difference for these insurance companies. So even if you've never so much as run over an empty Walmart bag, you could be paying inflated prices for accidents and injuries that had nothing to do with you. And before you blame your fellow man, it's not even really their fault either, because these increases don't always have to do with an accident actually happening. Insurance companies are setting prices to align with the worst case scenario. So it's basically like fear-based pricing. Yes, it's founded in the history of this happening before, of accidents and injuries that are very expensive, but theoretically, accidents could actually decrease over the years and claims could decrease over the years while prices continue to go up, because companies want to cover all their bases and make sure that they don't end up getting screwed over when somebody has a really expensive claim. And I mean, the data more or less lines up with it because even with claims going down, the payouts are considerably higher on the ends of insurance companies, and I can imagine that they don't like this. Hence the increased costs to you, the consumer. So prices are pretty bad. But is there hope on the horizon? Well, yes, but with a catch. NPR spoke with Washington State's insurance commissioner, who noted that while tariffs could threaten to increase car insurance rates, it does seem like the current rash of price increases might be leveling out at long last. And this is backed up by auto insurance executive Bob Passmore, who told NPR in that October article, quote, "The good news is that largely the industry is caught up on premiums, and we're now starting to see companies reduce costs and compete for business. We may have seen the worst of it." End quote. Of course, the catch is that it can take up to a year for any major changes to truly start being reflected in the insurance landscape. So while things might be settling down in terms of price increases, they could theoretically go right back up to record highs once insurance companies start being affected by things like tariffs, medical industry expenses, car manufacturing costs, etc. And look, I wish the news were better. But while I'm disappointed and a tiny bit mortified, I can't really say I'm surprised, you know? Because it's a complicated issue, and I'm not sure there's a singular culprit here. Everything is working together to drive up costs. Yes, you could argue that greed is part of the cause, but when you take into account that medical care is outrageously expensive and you account for uninsured drivers, and then factor in the costs of cars and their manufacture and their repair, it was basically destiny that we were going to end up here with people paying these exorbitant prices. And for coverage they probably aren't even using because they're afraid it's going to label them uninsurable. That to need the insurance identifies precisely why you don't deserve to have it, as if you're only allowed to have it if you can prove you can take care of yourself and your passengers and other motorists and your car. But don't you dare need this coverage, or we're going to be very disappointed in you, us, the insurance company, because that's not what we, the insurance company, signed up for. We signed up for you to pay us and do everything in your power to never need us. The fear of having companies view you as a greater liability risk over an accident that may not have even been your fault is a legitimate concern, even if the accident in question amounted to little more than a fender bender, because the price you pay getting something buffed out is likely to be less than if you try to go through your insurance. Car insurance today is basically an overpriced, undersized rubber because you're paying more to cover less, and you may never even get the chance to use it. But you have to have it, just in case you get the chance to give this nut a good home. Yet you can't even really rely on just yourself either. In driving, you never truly can. You have to rely on other motorists too, and the financial exposure drivers face simply by being on the road is arguably higher than it's ever been because of the aforementioned 30% of Americans who are either uninsured or limboing under the bar with bare minimum coverage that may not actually take care of them in the way they need it to. It's to the point where even a minor accident could financially set you back to adolescence. And I think what's made 2025 such a lousy year for a lot of people is that the cost of simply existing has never been more pronounced, much less the cost of driving. Hell, I've spent half this year talking about it on these Roman reports, and with damn good reason. Between the cost of cars, the cost of insurance, the cost of features and subscriptions, and all of this nonsense standing between an honest consumer and a practical product. It's just, I feel like people used to look forward to driving, yet I don't get that same enthusiasm anymore from people I talk to. It's just like, it's something to do. because driving is becoming less about freedom and more about risk. Just having a car at all represents potential liability, stress, and shifting financial responsibility. And that financial responsibility continues to shift because the goalposts haven't been secured to the field yet. And it would be more bearable, I think, if the system designed to protect you and insulate you from the worst consequences of motorized life didn't feel so much like a funnel steering you directly into them. But this is where we are, and maybe a worthwhile wish for the new year is that motorists finally catch a break. But what do you think? What's an actual common sense solution here, if one even exists? And how much of a problem do you think this even is, really? Do you see yourself anywhere in this story? I want to hear from you in the comments. Genuinely, my screen name is Limited Time Roman. I like hanging out in the comments, so let's talk it out. Like, comment, subscribe, share the video with someone you think might enjoy it, and if you love the show and want to keep it going, support us on Patreon for just $1 and get these videos early and ad-free, along with exclusive content you'll never see here. Thank you so much for watching and for supporting these videos in 2025. I genuinely can't explain to you what it means to me. When I started making videos for this channel, I never thought I would get to come as far as I have, and it's entirely because of you. So thank you. Please don't ever forget how grateful I am for you. I hope to do you guys proud in 2026. Have an amazing rest of your week. Well, I guess rest of your year.